Hello everyone, welcome back. Today, I want to talk about a financial planning scenario that I think a lot of people in their late 40s and early 50s will generally find useful. Now, I want to be very clear before I start. What I am sharing today is a general education framework. I am an AMFI registered distributor. I am not a registered investment advisor. So, what I am going to do is walk you through how I think about a situation like this, the questions to ask, the framework to apply, the goals to structure around, not specific fund recommendation, because that genuinely requires understanding your personal situation in detail. So think of this video as a thinking framework. The specific recommendations come after a proper conversation on a one-on-one basis for your individual situation, right? So let us get into this. So here is a scenario. Let's assume a couple and let them call Mr. and Mrs. Sharma. Mr. Sharma is 52, Mrs. Sharma is 47. They have just sold a property in Mumbai for 3.2 crore rupees. They have an existing fixed deposit of around 80 lakh rupees and around 48 lakh rupees in HDFC large cap fund that was invested back in 2018. Now, Mr. Sharma's salary is around 4.8 lakhs per month take away per, in hand. Mrs. Sharma's salary is around 1.7 lakhs per month in hand. So together they are bringing in about 6.5 lakh rupees per month in hand, which is a very strong income position. They have one daughter, she is 22 years old and she is studying interior designing right now. There are two goals that they have for her. First is at age of 25, that is 3 years from now, they want to give her 20 lakh rupees as startup capital for her own interior design business. And at the age of 28, that is 6 years from now, they are planning her wedding with an approximate budget of around 35 lakh rupees. And at some point, they need to think about their retirement as well. As I said, Mr. Sharma is 52, Mrs. Sharma is 47. So retirement is probably around 10 to 12 years away, depending on how they plan their retirement age. Okay. So that is the current situation for the Sharmas. So let us think through it systematically based on their goals. Step 1 is, before touching the 3.2 crores from the property sale, let us deal with the tax issue. Now, this is the most important that people miss. See, if a property was held for more than 2 years, the gain is long-term capital gains. So the gain is calculated as a sale price minus indexed cost of acquisition. And indexation uses cost inflation index to adjust the original price as per the inflation. Okay, so essentially, in simple words, this helps us to reduce the tax liability significantly after adjusting for inflation. Okay, so now there are two options for long term capital gain. One option is pay 20% on indexed gain and complete the transaction. Second option is to reinvest the capital gain, not the full proceed of the sale, but just the capital gain into a 54 EC bond within 6 months of the sale. This gives you tax exemption on the reinvested amount up to 50 lakhs. Okay, or you can reinvest in a residential property within 3 years under section 54. Okay, so the 54 EC bonds currently issued by NHA or REC carry a lock-in of around 5 years and earn approximately 5 to 5.5% interest, which is taxable, but they save you around 20% capital gains on the reinvested amount. Okay, whether 54 EC bonds make sense depends on the actual capital gain amount, not the full sale proceed of the 3.2 crores. So if the property was bought many years ago, the indexed cost might be significant and actual taxable gain. So this is the first conversation any reasonable planner or distributor should have before suggesting any investment. So the tax treatment of the property sale proceeds affects everything else, all the other decisions. So for this video, let us assume that the tax has been sorted and 3.2 crores is available net of any tax obligation. But in the real world, this is not the ideal situation, but we are just taking an case to case example or basic example over here. Okay. Now, after the taxation angle, now we have to move to step 2. That is to understand the existing portfolio before adding any new products to it. Okay. So as I said, they have around 80 lakhs in fixed deposit. So we need to know what bank, what rate that they are getting, when is the FD maturing, and what is the lock-in situation. Premature withdrawal penalty can affect a lot of decisions. So they have around 48 lakhs in SDFC large cap fund, which was invested in 2018. That is approximately 6 years of holding, and the fund has done reasonably well over the period. So the question now is, does this holding fit into new overall portfolio structure, or does it need to be rationalized, right? So I would not rush to redeem this portfolio or this particular fund, but I would think about where to place it in the overall allocation going forward. Okay. Now let's move to step 3, that is to map the goals to the timelines, and then we will allocate the different kind of products for achieving that goal. Okay. So mapping goals to timelines is the heart of financial planning. Every goal needs a timeline, and every timeline determines the appropriate risk level. So every risk level points to a category of investment. So goal 1 is daughter startup capital, which is 20 lakhs, and that is needed 3 years from now. So 3 years is a short horizon, and this is not money that you can take significant equity risk with, because 3 years is not enough to recover from a significant market drawdown. So the planning for this goal should be relatively conservative investments. So goal 1 is daughter startup capital, which is 20 lakh rupees, which is 3 years from now. 3 years is a short horizon. This is not money you can take significant equity risk with, because 3 years is not enough to recover from a significant market drawdown. So the planning for this goal should be relatively conservative investments, short to medium duration debt funds, conservative hybrid funds, or simply keep a portion of this existing FD earmarked for this goal. So you could earmark around 25 lakhs of the FD for this one goal, 1 to 2 year FD that matures just before the 20 lakhs is needed. So you could earmark 25 lakh of this FD amount for 1 to 2 years maturity, so that you can give 20 lakh rupees to your daughter for starting the business, and the remaining amount covers the interest and gives you small buffer. Now second goal is daughter's wedding, which is around 35 lakh rupees, and it is approximately 6 years from now is their plan. 6 years gives you more flexibility. You can take some equity exposure for a portion of this goal. A conservative allocation here might be around 60% in hybrid or balanced advantage fund, with the remaining 40% in a medium duration debt fund. Starting now, this should comfortably build up to 35 lakhs or more in 6 years, depending on the market condition. The key principle here is, do not take more risk with a goal money than the timeline justifies. A 6 year goal can absorb some equity volatility, but this is not money you want entirely in an aggressive small cap fund. And then there is goal number 3, which is the retirement corpus. And then there is goal number 3, that is retirement corpus. This is the most important goal and the goal with the longest horizon. So as I said, Mr. Sharma is 52, Mrs. Sharma is 47. So if we assume a retirement of 60 for both of them, that is 8 to 10 years away. This is their combined monthly income is currently, as I said, is around 6.5 lakh rupees. Take away their lifestyle expense, I am estimating for an illustrative purpose, might be around uh, 2 to 3 lakh rupees per month, and they are saving around 2 to 3 lakh rupees per month currently, beyond any portfolio decisions we make today. So the retirement question requires knowing, A, how much do they need per month in retirement to maintain their lifestyle, which is adjusted to inflation when they are above the age of 60. And B, how many years do they need for that retirement corpus to last. And let us say that they want 6 lakh rupees a month in retirement at the time of retirement as per today's money. So adjusted for inflation at around 6% over 8 years, that becomes approximately 9.5 lakhs per month in nominal terms of retirement. And over 25-year retirement, that corpus of approximately 8 to 10 crores depending on the assumed post-retirement return and withdrawal rate. So do they have 8 to 10 crores today for the property sale? They have 3.2 crores from property, 80 lakhs in FD, 48 lakhs in mutual funds. So total approximately around 4.3 crores is what they have as of today. So after allocating for two of the goals for the daughter and approximately 55 to 60 lakh rupees for the goals of the daughter, they have approximately 3.7 crores to work with for their retirement. Now, 3.7 crores invested for 8 to 10 years with appropriate equity allocation, say 60 to 70% equity at a blended return of around 10 to 12% could potentially grow to 8 to 10 crores by retirement age. And adding to that, continuing monthly savings of around 2 to 3 lakhs over the next 8 to 10 years, which we will then funnel into an SIP amount, and that is another 2 to 3 crore corpus which will be built from SIP itself. So the math is actually quite encouraging for this couple. Their income is very strong, their existing corpus is pretty sizable, their time horizon is pretty reasonable, and with a proper structure they should be able to meet their goals comfortably. That was step number 3. Now step number 4 is the overall asset allocation framework. Now let me talk about how I think about allocating the 3.2 crores from the property sale. Now, the most important principle is do not invest all of the amount at once. See, 3.2 crores is a large sum of money. Putting all of it into equity market in one go exposes you to significant market risk. If the market falls 30% in 2-3 months, then you have lost nearly 1 crore on paper. So the psychological impact of that is very devastating for most investors, right? So the right approach for large lump sum is actually systematic transfer plan, or STP. The money into liquid fund or short duration debt fund, we will put that large corpus in that fund and then slowly put an STP into our equity funds or hybrid funds wherever we want to allocate. Okay. So through STP, we are going to move a fixed amount each month into equity fund over the next 24 months. This gives you rupee cost averaging over equity allocation. You are not trying to time the market. You are simply spreading the equity investment across time. And second principle is to allocate by goal and risk tolerance. So the money earmarked by 3-year daughter goal, keep it conservative. Put that money in short duration debt fund or conservative hybrid fund. The money which is marked for the wedding goal for the daughter 6 years from now, that is moderate risk, so we can put that into balanced advantage fund or an hybrid fund. And the retirement corpus, which is a longer horizon, that we can put higher allocation in equity through systematic transfer plan over the next 24 months. Third principle is the existing portfolio needs to be put for an allocation, right? There has to be a tagging for that existing portfolio. So they already have 48 lakh rupees in an HDFC large cap fund. That is already significant large cap exposure in their portfolio, and any new equity allocation should complement rather than duplicate the same allocation. So we can think about whether you need a large cap or whether they need a mid cap or a flexi cap or international equity that adds better diversification. And fourth is to keep adequate liquidity for emergency. So with a corpus of this size, to maintain at least 6 months of expenses in a liquid fund or a savings account, this is the emergency fund that should not be touched regardless of anything that happens. Okay. Now we move to step number 5 to understand the ongoing monthly savings question. So they are earning around 6.5 lakhs a month. After expenses, let us say they have 2 to 3 lakhs or 3.5 lakh rupees per month as savings, and they have 2 to 3 lakh rupees as surplus. Okay. So this monthly surplus should not sit in a saving account. It should be systematically invested, continuing to build their retirement corpus through monthly SIPs across equity categories. Okay. So compared to the 3.2 crore lump sum, 3 lakhs a month sounds small, but over 8 to 12% per year, 3 lakhs per month becomes approximately 4 crores over the next 12 years. So that is not a small amount, and this is an ongoing wealth generation engine. Okay. And finally, step number 6, to ensure to protect all of this wealth. So at this kind of wealth level and this kind of life stage, the insurance picture really matters. That means that Mr. Sharma and Mrs. Sharma need to have a term insurance with proper adequate coverage. At 52 years old, with significant assets, the term insurance need, you know, actually be reducing because the financial dependency of the family is reducing, but it is worth having a good term insurance just for the peace of mind. Second thing, very important, is to have a health insurance. This is the most critical. A major health event without adequate coverage can devastate a corpus that took decades to build. So they need to ensure that they have a comprehensive family floater for at least 1 to 2 crore rupees plus a super top up. And then once the daughter starts her business, then there needs to be business insurance for the daughter when she starts her interior designing practice, because she will need professional indemnity or key man insurance, for her business to coverage uh, whenever there is some problems in the business, or at least just to have peace of mind in terms of business insurance. This was the whole framework for Mr. and Mrs. Sharma and how proper financial planning and goal based investing help them. So the risk is not that they cannot achieve their goals, the risk is that they might misallocate the large lump sum amount either by being too conservative or not letting it grow, or by being too aggressive and losing significant amount right before a major goal is due. So this is why we created this framework to protect their near-term goals with conservative allocation. Let the long-term retirement corpus take appropriate equity risk. Use systematic transfer to deploy the lump sum gradually and continue the monthly SIP discipline. So, which and then after this, the details are then which specific funds to invest in, exact allocation percentage, whether 54EC bonds are needed, how to structure the STP, in which funds to give the SIP, etc. All of that requires a one-on-one personal discussion. Okay, that cannot be generalized on a YouTube video. But if you are in a similar situation where you have a property you want to sell, or you have a business exit, or you already have a current portfolio which is not based on bowl, but you have just accumulated products over the years and you're not sure how you to structure it properly based on your family's goals, then you can book a free portfolio review with us at Auris Wealth. This is absolutely free for people who have a minimum investment of 5 lakh rupees and above, or a current SIP or capacity to do an SIP of minimum 50,000 rupees per month and above. Okay. What we do is we will look at the complete picture of your portfolio and give you an honest feedback and framework of how to think about your allocation. So the link is in the description. We do not do any forceful selling, pressure selling, etc. We are in the business of complete trust and honesty, and we will give you pure clarity about how your portfolio is positioned based on your life goals. Okay, so the link is in the description. Book your meeting today. This is an online meeting. Okay, so go ahead because the slots are limited. And also subscribe if you found this video useful. I try to make content like this every single week that gives you real frameworks on how to position your wealth, how to structure your wealth for long-term wealth preservation, growth, and transfer. Thank you so much. Have a great day. Goodbye.